So good morning, everyone. On behalf of both Stewart Title and Citibank, we'd like to thank you all for joining us today for our follow-up discussion to our educational series, which we hosted this year, centering around the TILA RESPA Integrated Disclosure Rule, commonly referred to within the industry as TRID. TRID continues to be a focal point in the mortgage industry, and today our intent is to build upon the series of presentations that we hosted in 15 cities back in March, April, and May of this year, which explained the new rule and how it was going to affect the consumer's mortgage experience and had additional focus on how it was also going to impact the relocation industry as a whole. So for those of you that had attended our previous sessions, first off, we want to say welcome back and thank you for joining us. And for those that are joining for the first time, thank you as well. And we hope that all of you find this to be an educational experience today. As we move closer to this implementation, the picture is growing clearer for how TRID is going to impact all of us within the industry. There's been a great deal of additional discussion, questions, and commenting, and we want to make sure that we share what we know to this point with you today. We're going to have three different presenters speaking on the call this afternoon. And joining us will be first Eric Arnold, who is counsel for all relocation-related matters for Stewart Title and also chair of the Real Estate and Mortgage Forum for Worldwide VRC. Secondly, Danny Angelo, and thirdly, myself, Chris Douglas. Danny and I are both relationship account managers for Citibank, with our primary roles consisting of managing Citi's relocation management company relationships. All three of us have been involved with developing and hosting these presentations this year, and we're definitely excited to be able to follow up that today with this presentation. So we've got a great deal of content that we're going to cover within this next hour. Hopefully our plan is to leave some time at the end for questioning, and if for some reason we do run long on time, Danny will talk about how we can make sure that all of your questions are answered, even if we have to cut the call short. So again, thank you again for joining us, and before we jump into content, I want to turn this over to Eric as the legal expert for a couple quick disclosures.
Thanks, Chris, and thanks to everyone for joining us today. I know we're really excited to get into this content, which we consider to be a bit of a level 201 approach to TRID. So the countdown tour, I still love calling it the tour, but the countdown tour, I think, really set the introductory framework. What does everyone need to know in the relocation industry about these upcoming rules and disclosures? This information, I think, tackles a few advanced topics, but really also brings us up to date. There have been a number of developments, as Chris indicated, and we wanted to bring everyone, the latest information that, is available that we know to be accurate in our go forward. Before we do so, I wanted to start off with a couple quick caveats. The first is that while we believe that the information we're going to be providing today is the most accurate and up-to-date material out there, we all must acknowledge that no one has actually originated or closed a single transaction under these rules. Until October 3rd, when we start seeing these forms and rules in practice, we should expect a gradual evolution. Once we actually have some hands-on with transactions under these rules, things should be expected to change around the edges, some nuances. So that's one thing I want to make clear, is that things are subject to change, absolutely. Second is that some of the material that we're going to present today will require certain decisions based on policy, based on risk analysis for your organization. Nothing that we're going to be talking about today should be construed as legal advice. We're going to provide you, hopefully, with the first steps. Take what we give you today and bring that to your advisors. This should be, a means to an end, not necessarily the end itself. So we strongly encourage that you work with your outside advisors to make sure that you're ready for TRID, and absolutely use this material as a starting point to get that conversation going. With that, I'd like to hand it over to Danny to get us started.
Well, good afternoon, everyone. And, again, on behalf of Citibank and Stewart, as both Chris and Eric mentioned, certainly want to thank you for joining us today. So both Chris and Eric mentioned the 15-city tour that the three of us really presented at earlier this year on the particular topic on TRID. And we thought it would make sense for us to pick up from exactly where we left off from those presentations. So for those of you that attended any of our sessions, you'll notice that the overview of the rule, these are really the key takeaways we left you with. And we'd like to take a couple of minutes just to provide a quick recap of what we feel are some of the key takeaways and some of the key changes with regards to this new rule. So first off, we know that we have new disclosures. So we have a new loan estimate that has been created that will be replacing today's good faith estimate in our initial truth in lending disclosure. We also have a new closing disclosure, which is going to be replacing today's HUD-1 settlement statement and the final truth in lending disclosure. So both of these forms, the idea was to develop these forms in a consumer-friendly fashion that makes the understanding of what a customer may be applying for and what the final terms of their mortgages are much easier for those folks. And I think what we found within the industry is that these forms are going to be beneficial, I think, to all of us because they are considered to be in a very easy to read, easy to follow format. Secondly, a cash to close section has been added to the new disclosures. So both on the loan estimate and the closing disclosure, the addition of a cash to close section has been included. And this is probably one of the most requested items that was seen when the CFPB conducted their consumer testing. This should be and prove to be a very benefit not only to the consumers but for those of us in the industry, as this is one of the most common questions that many of us field. So thirdly, we have a closing disclosure now that may be prepared by the lender or the settlement agent, but it's important to note that the lender is ultimately responsible for the timely delivery for this and ultimately responsible to prepare. So we'll cover this, we spoke at length about this during the tour, but we'll also highlight some areas on this particular topic as well today. Fourthly, we have closing disclosure must be provided at least 3 business days before the closing. This is probably one of the biggest fundamental changes that we will see from our closing process today. We certainly highlighted this topic during the tour, and we will spend some time on this topic again today. And then lastly, we have certain loan changes or annual percentage rate increases that may trigger a new 3-day redisclosure period that could potentially cause delays in the closing. Again, on the tour, we spent a lot of time talking about this particular item, as this is probably one of the most publicized pieces of this new rule, and we'll certainly touch on that a little bit today as well. So just kind of a brief, quick overview with regards to, the rule and what we kind of left off at, or where we kind of left off from our previous presentations.
So one of the most speculated upon topics regarding TRID has always been, will we actually go live on August 1st, which for at least 20 months was our understanding. The Bureau had been very clear that they expected everyone to be ready on August 1st and they had no intentions to delay. However, about 6 weeks before that go live date, on June 17th, we received public notice from the Bureau that they would be announcing an upcoming proposal to delay the effective date. This was due to an administrative error, namely under the Congressional Review Act, the Bureau and any federal regulator is required to provide 60 days advance notice to Congress before a regulation goes into effect. And so when this oversight was discovered, it was about, they would need to delay the rule at least 2 weeks to get 60 days advance notice in. Based on some of the feedback that the Bureau had received about concerns that these major changes would be going into effect in the busy summer months and that some in the industry were not necessarily fully prepared for an August 1st live date, the Bureau did proposed that the rule be delayed until October 3rd. Would note that they had to open this up for a public comment period, and so many in industry, consumer advocacy groups, and others did provide a number of comments, all very much in support of a delay. But it wasn't until less than 2 weeks before August 1st that we actually got our final rule, where we had a firm new effective date of October 3rd. Just to run through once again what that's going to look like in practice, it's all based on when the loan application takes place. So if a transferee or outside buyer applies for a loan on October 2nd, they are still going to receive a good faith estimate, and they're going to close with the HUD-1 settlement statement. It doesn't matter if the closing is in November or later. They're going to be closing with the HUD. If they apply for a loan on or after October 3rd, they'll be receiving a loan estimate, and then they will close with the closing disclosure. So once again, we're going to have a period where we're going to be closing under two sets of rules. Some transactions will close under the current rules with the HUD-1, and others will close with the closing disclosure with all of the applicable timelines that TRID represents. So it's going to be important to be ready to dual track these transactions once we start with the new closings. Finally, do want to address enforcement. It's long been a wish list item that there would be some kind of a grace period or a hold harmless period. The Bureau has clearly been hesitant on this topic to grant anything like that. They expect full compliance on the effective date, and that has been the ongoing theme. They've noted that they would be sensitive to good faith efforts to comply. However, that's not much of a standard I think anyone is willing to go by. We should all expect that every single transaction that is subject to TRID should use the new forms, should adhere to the new timelines, and be compliant in every way. They have no intention at this time of granting any kind of a grace period or hold harmless period.
So as we spend some time just talking about some of the changes in responsibility and some of the specifics around, the delivery, the timing aspects, and also the accuracy of the disclosures, I think it's important to highlight, one of the major changes with this rule is going to be the shift in responsibility to the lenders. So if you look at the process today, lenders typically provide all the preliminary information for the HUD settlement statement to the settlement agent. And then the settlement agent ultimately has responsibility for preparing, finalizing, and delivering this HUD settlement statement to the consumer. Certainly, between the process, there is a lot of involvement back and forth between the lenders and the settlement agent, but ultimately it's a settlement agent that manages that piece today. So as we fast forward to October 3rd and the integration of these new disclosures, lenders are going to essentially be the gatekeepers on all post-TRID closings, as they're responsible now for the accuracy of the financials and the preparation of this disclosure.
So in addition to being held to standards for accuracy, we're also going, as lenders, going to be held to standards for the timeliness and the delivery of these disclosures. So when we consider that, the timing of the delivery is going to play a very important role in how that lender operates going forward. While some of the timelines that we're going to work within today are going to stay the same, there's also going to be some changes that are quite substantial and are going to require a great deal of preparation for the lenders that's going to happen behind the scenes. Now, we'll expand on that a little bit later in the discussion, but for now, let's take a look at what items are actually going to change with regards to timelines beginning October 3rd. So first, the disclosure of the loan estimate or any changes made to that loan estimate thereafter are going to require disclosure to the consumer within 3 business days of either the loan application or after any changes have been made. In addition to that, the closing disclosure must be delivered no less than 3 business days prior to the closing of the loan. Electronic delivery of these forms will require e-signed act consent, and this is going to differ from lender to lender. Some lenders won't offer this right off the bat, others will. For example, Citi is going to be mailing out the disclosures within the required timelines. But it is safe to assume that if a loan estimate is not delivered electronically, neither will the closing disclosure in that process. And Eric, I know you had a little bit that you wanted to expand on within that as well.
Yeah, generally, if we are going to work with electronically delivered documents, we do need e-sign act consents to be obtained from the borrower before anything is delivered electronically. So generally, if that's going to be done, it's going to be done before, the beginning of the process. So before the loan estimate goes out, we're going to get e-sign act consents, and then all subsequent documentation will be delivered electronically. I think the question that, we're going to see is, okay, well, we sent out the loan estimate by physical delivery. However, it is too late in the process. We're only, say 4 business days from closing. We'll detail some of the closing timeline implications in just a second, but we don't have time to put the closing disclosure in the mail in order to close on time. Can we send it out electronically? And generally, unless the lender has gotten their e-sign act consents up front, that's not going to be a possibility. Perhaps it's possible to make that happen, but usually what we're going to see is that either all documents will be sent electronically or nothing's going to be sent electronically.
Now, lastly, for the last point we want to make here is for those lenders that are not delivering the disclosures electronically, time is going to need to be built into to account for the transit of the documents. Making sure that the disclosures are given sufficient time to be sent and then delivered to the customer so that they have the forms no less than 3 days out from the closing. The CFPB has made the statement that 3 days of transit is going to be deemed acceptable, and this has been dubbed within the industry really as the mailbox rule. So in essence, what that means is disclosures would need to be sent out a total of 6 business days prior to the closing in order to account for the 3 days of transit and then the 3 days of review. So for those within the group that are more or less visual learners like myself, we took a quick stab at charting this out over a couple different slides to give you an idea of how these changes are going to look. So the first slide that we have here really goes through the mortgage process as it is today and compares the current process that we're dealing with as far as how we send out disclosures compared to how we'll send out the disclosures as of October 3rd. So first, looking at the timing of the new disclosures being sent, under the current process today, you're going to see that the good faith estimate and the truth in lending disclosure statement are both provided very early in the process, usually during the time of pre-approval. Going forward, the loan estimate replacing those documents is going to go out later than what we had previously sent, the good faith estimate and the truth in lending. And this is due to the fact that now going forward, we're going to need to have a specific property in place before we can send out the loan estimate. So moving on, as we're all very aware, in the current process today, both the HUD-1 settlement statement and that final TIL are usually provided to the consumer at the last minute, and usually within the last 24 hours or so of the mortgage cycle. And as we can all agree, we operate in a very much an 11th hour business today. So looking at applications taken after October 3rd, we're going to be sending out the new closing disclosure earlier than what we had typically sent the HUD-1 and the final truth in lending. And this is going to be a huge win for the consumer experience as we look at this process.
And this is a graphic that I think is fantastic. It's published by the American Land Title Association because it takes kind of our viewpoint of, okay, well, here's our closing date. We know that we're closing on Friday. When do we need to have the disclosures in the mail or have them be received? So just to walk through a quick hypothetical, let's say we have a Friday closing. Well, in order for the disclosures to be received by the borrower 3 business days before closing, they must be received the preceding Tuesday. This could be via hand delivery, courier with signature confirmation, or potentially, there's some caveats with it, but electronic delivery could work as well, so long as you get your acknowledgement of receipt that day. So if we have same day receipt acknowledgement, then we could get the disclosures out the preceding Tuesday. However, if that's not the case, if we're going to be going via U.S. mail or some other mechanism by which the receipt will not be acknowledged, that we don't have the kind of evidence of receipt that we need, then the disclosures themselves will have to be mailed out the preceding Friday. And so generally you can see with the workflow here is that we're looking at 6 business days, including Saturdays, or basically 1 calendar week in advance of closing. The closing disclosure must go out if it's going to fit under this mailbox rule. And so this is what I think everyone is talking about as what's going to significantly change our process and our workflow to the extent that you need to review and approve the closing disclosure for direct bill credits, other charges that are within policy guidelines. That process is going to have to move up 10 business days, 2 weeks in advance to make sure that you're able to accomplish what you do today at the last minute.
And so as we look at this process, we know that many of the high volume lenders have provided some level of direction on what their process is going to look like when this rule goes into effect. And with the shift in responsibility that lenders are now faced with, there's also an increase in risk and liability. As we mentioned, lenders are ultimately responsible for all the accuracy in preparing and timely delivery in these new disclosures. For example, at Citibank, we've taken the stance that we will be handling all aspects of preparing and delivering the new forms. So this, from what we've heard within the industry, this seems to be fairly consistent within the industry from the lenders that we've spoken to and what we've heard across the board. Now, while the majority of lenders have provided their position in taking, almost full ownership of this process, there does continue to be some concern with some of the outliers, as some of these companies may be misinformed or even underprepared for TRID as this begins on October 3rd. We had mentioned during the tour earlier this year that there were some stories that we had heard of some lenders that were thinking that they may potentially be exempt from this rule, or that they're viewing some of these changes to be very similar to just a new HUD settlement statement. I think when the HUD was revised in 2010, the industry as a whole wasn't necessarily as prepared for those changes taking place and took a bit of a reactive approach. With the magnitude of the changes from TRID now, it's required a pretty significant investment from lenders and settlement agents with regards to our technology enhancements, training of our staff, and really an overall process change to ensure that we can be compliant with the new rule and also be providing that information in a timely fashion.
Absolutely, Danny, and I love the way you put that. I mean, this is truly an order of magnitude greater than what we saw in 2010, and industry is addressing that. I think that we've really been looking at this straight out of the gate. We understood that this was going to change everything, and so most of the high-volume lenders have been very candid and very upfront with their expectations. They're going to prepare the closing disclosure. Here are the timelines. This is the technology we're going to use, and these are our expectations. And I think that helps everyone to be able to understand what the rules of the road are going to be going forward. There, certainly are going to be outliers, and ideally, I do not want to overstate this case. I think we should be clear that this is going to be only the small minority of transactions are going to have to worry about this. But with the Tier 2, Tier 3 lenders, we may continue to see some, confusion or concern about this. I travel around to hear terms like, the closing disclosure is the new HUD. That's a nice shorthand, but it's not really. There's so much more to it. It's not just a new form. Over half the form is loan information. It's no longer just a statement of charges. There's so many additional rules regarding use of this closing disclosure that if someone calls it a new HUD, I tend to, makes the hairs on the back of my neck stand up a little bit, want to do a little bit more digging to see, are we really comfortable with, that they understand how this transaction is going to look. But really what I think we should shift our attention to is not those who do not know about the rule, but those who are looking to comply with the rule but are just concerned about their internal process. So TRID permits a lender to authorize the settlement agent to prepare and deliver the borrower's closing disclosure. This is something that we wanted to have that kind of flexibility. However, I think as industry, both from the lending community and the settlement agent side, have analyze this further with all of this falling under TILA, which has significant compliance risk, and also the marketability of the loan. A number of implications could arise if the closing disclosure is prepared or delivered out of compliance tolerances. And so given that, the questions really come up, okay, well, the lender may look to the settlement agent to prepare the closing disclosure, but should the settlement agent do that? Should they take on what effectively will be the lender trying to offset their TILA liability to the settlement agent? And settlement agents in the title industry has never dealt with TILA. That has strictly been within the mortgage community in the past. the title industry is well versed in RESPA. We understand those penalties and the obligations, but TILA has clearly been a lender statute, and what we're seeing is some hesitancy to accept the TILA risk that would be offset through the lender's closing instructions or otherwise if something was to be missed, frankly. So that's the question that we're really getting right now is, okay, well, if the lender does look to the settlement agent to prepare the borrower's closing disclosure, can or should the settlement agent do so? And if they decline, what are we going to do then? Do we have to choose between getting a new lender or finding a new closing office? So these are conversations that absolutely it's critical that they take place as soon in the process as possible. Talk with the lender. Find out, are they going to be preparing the closing disclosure, which I would expect in 90+% of cases they will be, then fine, there's no issue. But if they will be looking to the settlement agent to do so, then we need to have those conversations as soon as possible. So technology will truly define the post-trade closing process. This is publicly one of the Bureau's goals, is to look at the way the technology can improve the mortgage and closing process. And through TRID, I think we get to see our first glimpses at how that will play out. What we're going to see is a variety of approaches. We're going to see something from a purely technology-driven integration between lender and settlement agent to a continuation of the very manual process as we may see today. Just to start off, what does this technology-driven integration look like? Well, generally, we're going to use some kind of a portal. This is going to be a software platform that the lender and settlement agent can communicate directly in real time. So the settlement agent will be providing all applicable fees up to the lender so that the lender can prepare the closing disclosure in time. The lender will be communicating all terms and requirements of the transaction. All timelines, policies regarding revisions, etc., will be handled here. If there are any changes that come up, the settlement agent will report them to the lender, and we can get a decision from the lender as soon as possible. This is going to be the best way to avoid closing delays and other issues, is using this kind of an integrated approach. It's going to eliminate all email, fax, and alternative document delivery methods. One of the things that using this kind of integration allows us is to prevent inadvertent disclosure of a transferee or other consumer's private information. So now we're not going to have a variety of means of transmitting documents. Everything is going to go within a secured and encrypted portal. One of the platforms that I think is gaining a lot of industry acceptance that you'll likely see on your transactions is Closing Site. Many title production platforms, including Stewart's AIM Plus, are directly integrated with that, but there are also other approaches. Citi, for example, has developed a proprietary platform to handle all of these functions. And Chris, would you like to spend just a bit of time talking about Citi's platform?
Sure, and I agree, as Eric alludes to here, and it's something that we've spoken to in our previous series, is that technology is a huge piece of what we're working on. And I think it's going to be more critical than ever as we move forward to create an efficient and dependable process. Citi, as Eric mentioned, has developed our own proprietary platform, and the intent there was for this new technology to work with both our current mortgage platform that we operate within today and also our document delivery sites for our title service partners. Our intent here was to make this transition as seamless as possible in front of the curtain, if you will. And as we move on and look at that next point there, it's going to be reasonable, given that the timelines that we're discussing, to expect to see a lender reaching out to title service providers 10 or more days out now for their information, with the expectations that the return of that data be provided back to them within as little as 24 hours. Speaking specifically to Citi's direction, we're going to be targeting that 10-day window, knowing that we're going to be mailing out the closing disclosure to the consumer 6 days in advance of the closing. So in the last bullet point there, to minimize the different mediums of communication, most lenders are going to utilize a portal, whatever that portal may be, to handle all the communication through that means. And the intent there to do that is to take out the chance of any example or possibility of a communication breakdown. Eric, do you have anything that you want to add to that?
I think that's really consistent with what we're seeing across the industry, the use of these kind of portals. And this is really the best case scenario. Many of the things that are handled at the 11th hour right now will be done 10 business days in advance of closing. And I think that this is going to help alleviate many last-minute headaches and concerns that we may see today. So going on to the other side of the spectrum, and this is a purely manual process. What this would look like in a TRID closing is that the settlement agent would be providing a pro forma closing disclosure. It would be watermarked or otherwise unusable as a final, or some other statement breakdown of charges and provide it to the lender in order for the lender to take that information and prepare the live closing disclosure for the borrower. So, there is a little bit of duplication of effort on settlement agents preparing it so that the lender can include the settlement agent's information on their own more comprehensive closing disclosure. This manual process maintains the phone, fax, email system of today. So we do have certain risks that go along with this kind of a transaction in that being able to track when disclosures have gone out, making sure they've been received on time, what is our closing timeline, how are approvals and revisions handled. All of this will be, just as today, done via these much more manual methods, but the downside, the potential for a delayed closing, I think, is much greater when we're using this kind of a manual process. And then, to be sure, there's going to be every shade of gray in between these two extremes. Some form of piecemeal integration so that a lender, may have something for preparation of the closing disclosure. So the settlement agent can't communicate fees, but all of the rest of the process, all of the timelines and real-time tracking might not be available, or, any shade of that. There's some form of integration, but certainly not, a comprehensive integration. So, one of the things that we continually will stress is kind of understanding what capabilities the lender has, whether it be on a home purchase transaction with your lender partners that you may use across the country or regionally, or on the home sales side. This will absolutely come into effect when, all of these will be determined by your outside buyer's lender. So finding out how the transaction will be handled from a technology standpoint up front is going to, I think, alleviate some concerns about potential for delays and what that timeline is going to look like.
Yeah, I couldn't agree with you more on that piece, Eric. I think, as a lender from the side of our fence, when we look at home purchase transactions, it's our goal to provide that level of understanding and communication to our partners on what our process is going to look like. But I think the home sale piece is definitely an area that's going to be a bit fluid, as TRID rolls out and we're working with lenders potentially outside of a network. So very good point to make, I think.
So putting the lawyer cap firmly on, one of the big concerns with these new forms is how to protect a borrower's non-public personal information. We're not just using a statement of charges as the HUD generally was, that was the thought process with it. Now we have a 5-page closing disclosure with basically 3 pages filled with loan information, much of which would be considered private and confidential under either state or federal law. And so the question comes up, how do we protect this in this new world? And I'd like to defer to Citibank for, what's your approach to handling this privacy issue?
Yeah, very good point, Eric. And I think, it's important to note that even outside of the new disclosures in TRID, protecting customers' privacy, it's a major focus and responsibility for both lenders and settlement agents. And that's certainly going to continue and translate into how we deliver these new disclosures. So for Citibank, our approach is going to be requesting separate closing disclosures. So we will obviously be preparing and delivering the borrower's closing disclosure and handling that piece of the function. But we're also going to require and request that the settlement agent prepare and provide a seller's closing disclosure. So that would be the default for Citibank's process as we move forward. And what we're hearing within the industry, this has been somewhat consistent as being the default for most lenders to ensure that we are protecting our customers' private and public information or personal information.
Absolutely. And, I think that's what we're going to see is, separation of the buyer and seller side closing disclosures. We do, as we've noted, have a separate seller-only version of the closing disclosure, which is just 2 pages. And I think that's, what we're seeing is very much a focus on separating these out. Now, in the relocation context, I know it has, sometimes there's historical precedent for requiring a copy of the buyer side HUD. I think that this is a good chance to consider whether we want that policy going forward to see the actual figures themselves. If that is the case, then you would need to get a release, an authorization from the borrower to be provided that, whether it be a separate authorization or a part of your rider. I think we will, detail in a bit ideas for getting the signatures of the buyer. Maybe that could be done through some of these supplemental documentation. But if you do want the borrower's closing disclosure, that should be handled through a release.
Yeah, and one thing I would jump in with that on Eric is when we look at our process internally, we're going to continue to mail out our customer authorizations that we use today to what we use to release information. And we're going to send that out during the welcome package at the time of pre-approval, just normal course of business. And I think the intent here is to make sure that we've got this signed release back in our hands as soon as possible to make sure that, if there is any release needed, we can do that.
So we noted briefly about concerns with the way that title insurance premiums are disclosed during the tour itself. Noted this as an issue, but didn't really want to go into too much detail because there's so much to cover. I do think that a forum like this is a perfect opportunity to really to detail what the concern is so that you can be aware and watching out for this in your transactions. So the issue is when we have a simultaneous issue discount. This would be a case where if you purchase both a loan policy and an owner's policy at the same time, in about half the states you'll receive a significant discount on your loan policy. The Bureau is concerned about the way that this would work within their disclosure parameters, and so they have given us a calculation that we must provide in disclosing simultaneous issue discounts. And they acknowledge that it's going to require title insurance be disclosed quote unquote different than the actual rates charged. So I give a hypothetical of a Texas transaction. We have a $300,000 property and putting 20% down, so we're going to have a $240,000 loan. So the actual amounts charged, on the title side, we don't have flexibility in what we charge. We have to charge, the applicable rates. So for that property, we would have a $100 loan policy, and $19.83 would be the premium for the owner's policy. Well, under the CFPB's guidelines, the closing disclosure will reflect this as $16.51 on the loan policy and $4.32 on the owner's policy. The rationale for this is that we have to show the undiscounted premium for the loan policy. So that's going to be the premium for that $240,000 loan, and then everything else goes under the owner's policy. So if you take both sets of fees, they both add up to the same amount. However, you basically divide the pie differently. We do always like to note this as an issue in the mobility context because if your policy covers only the loan policy but not, say, the owner's policy, or if you're negotiating with the other party, whether it be buyer or seller, to cover one of these policies, then you're going to absolutely need to know what's the actual amount charged. The closing disclosure, the idea is to just show the incremental additional expense for the owner's policy, but that does not line up with the amounts actually charged, and you need that information. So in order to address this, the American Land Title Association put out their settlement statement. We hinted at that this was something that was in the works. For I believe the first 10 cities on our tour, this was a project that was ongoing. And for the last few dates, we actually had seen what the first version of the ALTA settlement statement was going to look like. And so this was something that was very much in process during our original countdown tour. And now we've had some time to take a look at that and get used to the workflow with that. And what we're going to see is that the ALTA settlement statement will be provided in addition to the closing disclosure. It's a document that your title providers would be giving you on top of the closing disclosure. And it will itemize all charges without some of these discrepancies, without these, particular rules that the Bureau has given for the way charges are on the closing disclosure. We can actually show you what was charged for that title policy on this ALTA doc. So that's something that will clear up that issue. Also, the settlement statement will provide the signatures of the parties. So right now, the closing disclosure only provides a spot for the borrower to acknowledge receipt. And so I think that what we're going to see is that in most states, that ALTA document is going to be very useful for clearing up some concerns that the closing disclosure represents. There are some states, I would note Texas as a prominent example, where there's going to be a state promulgated form. So you may not be receiving that ALTA document. Definitely work with your title service providers to make sure that you get the information you need on a purchase transaction. Work with your mortgage partners. Just make sure that, these are our expectations for our transactions, and find out what documentation you can receive to make sure you get the information you need.
So as we move on from talking about the content of the disclosures, it's also important to think about the actual process and the impact that it's going to have. One of those is going to be the potential impact on closing dates. So probably the most vocal concern from the industry that was, and quite frankly still is going to be the potential impact of delayed closings based on the new timelines and the guidelines that lenders are going to be required to follow with TRID's implementation. Given the potential costs to delay these closings on a large scale, this implementation's effect could be quite substantial, given the initial expectation that any fee change of $100 or more would trigger a delay of 3 business days. Now, obviously, we understand that that's not going to be the case, and after much feedback from or given to the CFPB and a thorough review of that rule, it was determined that there's really only going to be 3 examples that would require a 3-day delay in closing. And to reiterate those 3 examples, they're as follows. First off, an increase to the APR that goes beyond the threshold allowed. So if an APR raises above an 1/8% on a fixed rate product or a 1/4% on an adjustable. However, no longer will a consumer be required to wait 3 days if the APR goes down as it does today, exceeding the threshold. Going forward, it's only going to be a raise in the APR that's going to affect a delay in closing. Secondly, a change to the loan products, such as switching from a 30-year fixed rate mortgage to a 15-year fixed rate or a 5/1 adjustable rate mortgage, will require the consumer to wait 3 days to make sure that they've got sufficient time to consider the change in their monthly obligations. Lastly, the third example would be the addition of a prepayment penalty that would also require a 3-day waiting period before closing. And I think when we look at the industry, most of the national lenders that work within this industry don't offer any type of prepayment penalties, so this is going to be an example that will be few and far between. But it's important to note that some lenders out there may still practice that and adding a prepayment penalty to a mortgage. So if that does happen, that the consumer is protected against making sure that they do want to move forward with that new feature in the loan. So as you can see in the illustration also added here, I think the concerns were so prevalent in the industry that the CFPB even felt the need to release a white paper to go over this in detail to help put to rest some of that misunderstanding within the industry.
Yeah, and I think, while Chris highlights some of the scenarios that would require a redisclosure and potentially delay closing, it's important for us to note that there are certainly other ways and other scenarios that a closing could be delayed due to TRID. Now, these scenarios aren't necessarily going to be driven by a redisclosure period that triggers this new 3-day waiting, sit on your hands and wait period. They're going to be more driven around process. So, first off, with the initial closing disclosure, if that is not delivered in time, meaning that we know that the customer has to receive the initial closing disclosure at least 3 business days before closing. And in the event that a lender is not prepared to deliver that in time or misses that deadline, the expectation in that scenario is that the lender would delay closing to avoid being out of compliance and risk any potential liability based on the rule. So this, again, I know we've stressed this as we've talked today, but this is where understanding the lender's process is critical to avoid any delays. Understanding that, at certain points of the process, lenders are going to be asking for items much sooner in the process than we do today. So that's probably the most overlooked concern in a potential closing delay, is getting that initial closing disclosure sent out. I think Chris highlighted it well, that there's been a lot of publicity around the 3 points that would potentially delay closing and create a redisclosure, while this initial closing disclosure being delivered in time has not necessarily gotten as much attention as it probably deserves. So as we talk about, walkthrough credits, this is probably, I would have to say, and I think the group could agree with me, that this is one of the most common questions that we've been asked as a group, is that if there are minor walkthrough issues, will those types of issues, will those types of credits potentially delay closing? While the easy answer is no, as minor credits would not necessarily invoke a redisclosure period where we have to wait 3 days, there is still a potential delay due to the process. So with the lenders now being responsible for the preparation of the closing disclosure and the delivery, this means that lenders are ultimately responsible to handle all of the revisions as well. So in the event that a credit needs to be added due to a walkthrough issue, it's going to be the lender's responsibility to revise that new closing disclosure and then deliver that closing disclosure to the borrower, and then also deliver the new package to the settlement agent. So same-day walkthrough issues could potentially pose a problem depending on the timing of closing and the lender's process. So I think it's important to really note that while walkthrough issues don't necessarily affect that 3-day redisclosure period, the lender's process and them handling that piece could add a bit of a delay.
Yeah, I'm sorry.
Go ahead, Eric. I'm sorry. I was just going to mention for you.
Yeah, one thing we always like to note on this is what about time is of the essence clauses? If we do have a delay that's going to be required because of TRID, is that going to trigger a time is of the essence clause? Is that going to allow potentially one of the parties to walk from a deal? And how do we address that contractually? Is there a way, to the extent that a real estate contract includes this language, strongly recommend working with counsel to figure out whether you can include some kind of an exception language, and definitely watch this space. This is a big unknown at this time because, to my knowledge, none of the real estate contracts that include this language have really taken TRID into account in changing that language.
So we're going to switch gears again and talk a little bit about how the implementation of this rule is going to impact the lenders. And when we look at this rule internally from a lender's perspective, the story of how we're going to get there is actually bigger than the rule itself. This was going to be a huge fundamental change, as Danny mentioned previously, in how we're going to operate our business. And much needs to be considered in how we're going to do that. From the lender's perspective, developing the technology to build a platform that's going to support the preparation and the formatting of the documents is going to be paramount. These platforms, in most cases, are going to need to work with some of the programs in place today, and will require extensive testing, not only of the technology itself, but also for the staff that's going to be using it. As we discussed earlier, in addition to working with the lender's internal systems, these new platforms are going to need to work with the settlement agent systems to ensure that the documents and instructions will be delivered securely, accurately, and also timely to allow those on-time closings. So since lenders are going to be taking on these new responsibilities and obviously an expanded role in the process, the need for staff training and awareness has grown quite a bit as well. Most of the lenders have been preparing their staffs with training sessions and education leading up to October 3rd. Within Citi specifically, we've initiated email campaigns going back as far as July of 2014, and we still continue this today. All of our employees are going to be required to complete training with testing that proves a mastery of the materials before they can even begin to work with the new disclosures. Another area that's getting a lot of attention is the availability of the staff for the increased need to amend and prepare these documents. Going forward, it's reasonable to assume that lenders are going to need to consider the hours and the size of closing staffs to accommodate all the new responsibilities that they have. And when we look at this externally, there's going to be a much more focused approach to lenders and to the title service providers that they work with. Service level agreements, or SLAs, are going to be developed or amended to comply with all the new guidelines and timelines that lenders are going to be held to. And given the increasing need for a strong and dependable partnership, it stands to reason that seeing lenders begin to move away from ad hoc providers as we go forward. Given the responsibility that the lender's taking on, it's going to be a potential risk to depend on a provider that's not invested in the relationship.
And I think, Chris brings up a great point, but it's no secret that, the amount of investment in the implementation for TRID, I mean, it's a pretty involved and a very, extensive process for us as a lender. To highlight a couple things, though, it's not just the lenders, it's not just the settlement agents that are having to enhance their process, potentially their technology, but there's also some key considerations, I think, for the relocation industry as a whole. As we look at client policies, so reimbursement policies that are in place today, there's a few areas that have gotten a lot of attention and a lot of focus as of late. Number one, with the owner's title insurance, Eric certainly highlighted some of the concerns with regards to the simultaneous issue rate, and where we're going to have to utilize some supplemental documentation to ensure that we have that calculated and shown properly. Probably the biggest piece that we have seen on the lender side and the communication that we've had with our clients and our partners is around origination charges. When we consider origination charges, specifically loan origination charges versus loan origination fees, there is a bit of a difference. And now effective October 3rd, the use of the term origination fee will no longer be available. So according to the CFPB, lenders may charge origination charges, but any charges to originate a loan other than points, they're going to require a clear and conspicuous terminology that describes the individual service and charge that's being imposed on the client. So client policies today that reference a loan origination fee are more than likely going to need to be reviewed and potentially revised. And trying to understand is what is the purpose of that client's policy, what are their intentions and their goals in providing a reimbursement benefit for their employees. So understanding that this is a major topic within the industry, for Citibank, we recently published a white paper that specifically addressed the difference between loan origination charges and a loan origination fee. Because it's been such a hot topic, that's been an ongoing conversation amongst really all of the lenders in the industry and clients and partners to discuss those reimbursement policies. When we consider the use of other forms, it's no secret, and this is something that I think, as we go back to the tour earlier this year that Eric and Chris and I spoke at, we know that the closing disclosure, while it's such a fantastic disclosure in so many different ways, it doesn't necessarily meet all the needs that the HUD-1 settlement statement does for our industry. So for example, we've highlighted this, but the closing disclosure does not capture signatures from all parties on the form. It's simply an acknowledgement of receipt that on the borrower side that they signed to acknowledge that they received it. It's not time-stamped. It's not a situation where it confirms that closing actually took place. So the HUD settlement statement, we typically see that in most client policies as being required for accounting and billing purposes because it does capture all of the signatures from the parties. So with that closing disclosure not necessarily meeting that requirement, to Eric's point, the use of supplemental documentation is most likely going to be the preferred method to, fill this need and fill this void. And Eric, as he mentioned and referenced the ALTA settlement statement, this is a form that, from what we've heard in the industry, most lenders have elected to use as supplemental form and required for their closing transactions. For example, with Citibank, again, we've taken the stance that we will be utilizing and requiring the ALTA settlement statement in all the states that it's applicable. So the use of those supplemental documentation should help fill the void. But as we talk about, client policies and reimbursement policies, some of the verbiage is also going to need to change, and the understanding around, what forms are they going to need for their reimbursement policy? Will they accept a closing disclosure, and will that satisfy their needs, or are they going to require the supplemental in addition to the closing disclosure?
Yeah, and just a few final considerations, and I think Danny does absolutely hit it on the head when the ALTA settlement statement. Whether there's other documentation that's necessary, when it comes to auditing your programs, what are you going to use for evidence that a transaction closed? That's where we generally see use of buyer signatures. So making sure you get the documentation is critical. But also, beyond that is reviewing contracts to, with an eye towards TRID. This is where those who have their eye on this material will be able to spot issues. So time is of the essence is another. What are you going to do in the case that a buyer's lender is unprepared? What options do you have contractually, whether it's per diem penalty, which I think many are nervous about the application of those in this scenario, but there are considerations to be made because ultimately if there is a delay required by TRID, it's going to increase the overall costs of the relocation. Finally, it's going to be critical to prepare transferees for a new closing process. If they've moved 3 times in the last 5 years, or someone that's a sophisticated homeowner, this isn't going to be the last time they bought a house. We're not going to have a 14-day or probably even a 30-day close. We're most likely looking at 45, even 60 days. And Chris, did you want to comment on what you're seeing in that along those lines?
I would. While we're not taking the approach that we're drawing a line in the sand as far as a specific day, I think that the setting of expectations for closing is going to be of utmost importance as we move forward with this. Not only does the lender need to set proper expectations for the transferee, but all counselors involved in the process, whether that be a real estate agent, a relocation counselor, or a mortgage consultant, need to be educated on the changes and be able to put that consumer in a position to move forward with a successful transaction. For an example, in addition to discussing the changes during the loan consultations with the mortgage consultant, Citi is going to be also providing additional information in the welcome packets that speaks specifically to TRID and to this new process. The more information that we can give to them, the better armed they're going to be able to be with putting in an offer on a property and closing in a reasonable timeline. And I think it goes beyond just timelines of closing. It also talks about, we mentioned earlier talking about different releases, to be able to get information out. Being able to get in front of those customers and get those documents signed right up front is going to be very important as we move forward.
Absolutely. And for today, for our presentation, this concludes, some of the information that we wanted to share with the group. And I think, on both behalf of Citibank and Stewart Title, Eric, Chris, and myself, we certainly want to thank everybody for joining us today. I know that we are right at the top of the hour, and we do have the availability to go over for a few minutes to be able to answer some questions. We have received several questions today from some of the attendees that we'd like to start to address, and just want to make a note that whatever questions we are not able to address on the call today due to time, we will certainly address individually with the folks that presented the questions to make sure that we're answering those questions that you have. So, to kind of kick that off, I'll start with one of the first questions that we received. So the question states, at walkthrough, those that impact value, for example, a plumbing issue for $350, the seller agrees to give a credit, the consumer agrees to accept. Do we agree that the creditor must be called for approval, revision of the closing disclosure, and then sent to consummation for signature, even if it impacts the loan to value? So when we're talking about the creditor here, we're talking about the lender. And the short answer is yes. Anytime that we're going to be adding a credit onto the closing disclosure, it's going to be the requirement that the lender reviews, prepares, and provides that closing disclosure to the borrower, and that the seller's version is updated by the settlement agent. So if there's any changes on the seller's version, that they would need to update that. But yes, the short answer is that the lender would need to be notified of that credit, and that we would need to revise those disclosures. We did have another question that came up recently about will these new changes potentially add an increase in credits that would be applied or outside of closing, so an exchange of money or credits outside of closing to avoid having to put them on the new disclosures and potentially create delays. And, the answer for that is, while that may be the concern, the goal of these changes is not to delay the process. And for a lender, we're going to specifically state on our closing instructions that any credits need to be submitted to the lender and need to be added to the closing disclosure. And Eric, Chris, if you have any comments to add, I'll let you chime in on that. But, those are some of the questions that we've received with regards to, some of those issues being handled outside of closing.
Yeah, this is Eric. Just a couple comments. I would say even beyond whether it impacts loan to value, if it changes anything on the borrower's closing disclosure, it's going to need to go back to the lender. Generally, lenders, and this will depend on each particular lender's requirements, but they're going to be preparing the revised, any final closing disclosure for the buyer. And so if there's anything that changes on that document, it's going to have to go back through the lender. So I wouldn't really think of it through a loan to value lens, but just does the document need to be revised to make it final and accurate for closing? And as to any credits being given outside of closing, this isn't RESPA we're talking about. This is TILA with significant penalties for disclosure violations, and so pretty much everyone to the transaction, from the lender's perspective, from the settlement agent's perspective, if we, get wind that there is a credit that's being provided outside of closing that's not reflected on the closing disclosure, we're going to have some significant concerns. So that should not really be considered an option in any scenario.
So for our next question, just trying to go down the list here, we have our realtors being trained regarding these new rules. I have spoken to several realtors and they know nothing of the new changes. So Eric and Chris, if either of you want to chime in, I'm happy to take it as well.
No, I'll definitely chime in on that. I think it's a very good question, and I think when we look at this from an industry perspective, it's definitely a concern that any parties, involved in what we do are uneducated in this new implementation. While to speak specifically for a real estate agent, I don't want to do that, but I know that there have been certain membership groups or chapters that have reached out and provided education materials to the different groups and specifically to real estate agents. I think that the education is out there, but again, speaking to that group, what we're doing here is a perfect example of some of that education that's been pushed out, and obviously we do this for the industry as a whole, and it comes down to the agent themselves as far as, do they open the emails that are sent out containing the information? That part is difficult to answer, and I think you would have to refer back to each agent, as far as what steps they're taking to educate themselves. But, when we look at this from our perspective, we're doing everything that we can on our end to be able to educate the industry as a whole. Eric, do you have anything you want to add with that?
Yeah, I'd just say that NAR, has been very clear that, they know how to educate realtors. And so they have a plan for how to get this information out. And, so there have been some, attempts to communicate, get this education out. But I would say that within the relocation space, when we're working with a preferred brokerage network, this is something that, should be used. Are you ready for this? Reach out, make sure that the folks that you work with on a daily basis are ready for these changes, because you don't want your transferee to be working with someone that doesn't know the new rules, or that is going to be just as surprised as everyone else. So I think that this is, a good opportunity to make sure that the folks that you're working with are proactive in their education to the extent that they're not quite up to speed, making sure that that's a requirement to, work with. So this, I think, is going to, weed out some folks that aren't quite as proactive in their education. And I'll take two questions that have come in firmly within the title space about the use of seller documents. So the first is, when would we need to use the separate seller's closing disclosure? And then, following up on that is, would we need to approve it? So the seller is going to get a closing disclosure. They're either going to get the separate 2-page seller's closing disclosure, or if the buyer has waived any privacy concerns, the seller could also be receiving a 5-page closing disclosure that's going to show both the buyer side of the transaction and the seller side on the same document. I think, as we mentioned, we'll most likely see that sellers are going to be receiving this separate standalone 2-page closing disclosure. The only requirement under TILA, under TRID, is that they receive it at or before consummation. Consummation is the date that we're really talking about. It's the date that you sign the note. Whenever we talk about closing with this, that's technically, we should be referring to consummation. These disclosures must go out by the time that the borrower signs the note. But it can come out if it's finalized, and if it's ready to go, you could receive it before the date of consummation. And so that's something to work with the title, with the title company to make sure you get it in time. When it comes to approving it, I would break this out into 2 ways. From a relocation perspective, you absolutely should, say in a home sale program, expect that your title service providers are going to give you an advance copy to review and approve before we actually get to consummation. If this question is from the perspective of a lender, generally the closing disclosure will be provided to the lender after closing, or maybe as a prerequisite to funding. So the lender will get a copy of the seller's closing disclosure, but generally that's going to be, it's not going to be an advance review from the lender's side. And then the second question is, I love this, where, when, and how are the representatives for the sellers in a home sale program going to get the seller side form, whether that be the closing disclosure or the ALTA settlement statement? Is this something that title companies are going to provide like they do with the current HUD? And I might say, if you are working on the home sale side, this should be an expectation. This should be, whether you want to work with that closing disclosure or whether your title provider can give you the ALTA settlement statement, I would expect that you should have the opportunity to review this in advance of closing, just like you do today. In many cases, this should make that process even better because many figures will be finalized much sooner in the process than they currently are. So I would say that you absolutely should expect to receive something in advance. What you receive, whether it be the ALTA settlement statement, whether it be the closing disclosure plus, say in Texas, the state promulgated forms that explain certain issues, that I would reach out to your partners to figure out, what works for your organization to meet your needs. And so I believe that takes us through all the questions that we received. If there's anything else, we'd certainly love to address them.
Well, if there's no further questions, we will go ahead and wrap up here. Again, on behalf of both Stewart Title and Citibank, and Eric, Danny, and myself, we want to say thank you for the time, and we hope that you found this to be educational. I think it's safe to say that, as we sit here today, we're not through with this yet. As we move forward to October 3rd, there's going to be additional questions. We would go ahead and invite any of you to reach out to us or any of your partners within the industry to ask any questions that you find to be important to your portion of the business. We will definitely continue to send out educational materials to you as we move forward. And again, just want to say thank you for the time, and we'll let you go ahead and get back to your day. So again, thanks for joining us.